If you're still asking whether you need 20% down to buy an investment property here in Texas, you're thinking about this at the wrong level. Sophisticated investors don't optimize for minimum down payment. They optimize for capital efficiency, durability, deployment velocity. Because in this market, the way you structure leverage determines whether your portfolio compounds or it becomes more fragile over time. So today, I'll show you how to evaluate down payments strategically instead of emotionally. Let's dive in. Today, Texas continues to attract population, corporate relocations, rental demand, but capital isn't cheap. So at high interest rates, over leveraging, it'll compress margin. Or if you overcapitalize or allocate too much capital to a project, it'll reduce your internal rate of return or your IRR. And then poor liquidity, it increases the systemic risk that you take on by purchasing a certain piece of real estate. Meanwhile, lenders are tightening in some areas while becoming more flexible in other areas, especially with AI-driven underwriting that evaluates global borrower strength. Structure now matters more than it ever has. In Texas today, conventional investment loans typically require 20 to 25% down. Strong borrowers may qualify for a 15% down option. Owner-occupant style loans like FHA or VA can go from 0 to 3.5%, obviously with occupancy constraints. Private and commercial loans vary widely, very, very widely. Everything from 0 to requiring 50 or 75% down. But the percentage isn't itself really the strategy. The strategy is how the percentage affects cash flow durability, your liquidity position, risk exposure, return on deployable capital. That's where the real sophistication and strategy behind your debt stack begins. So let's use an example. Purchase price, $300,000. Your rent is $2,200 a month. Scenario A, 25% down is $75,000. You have a lower monthly payment, stronger cash flow cushion, lower long-term interest expense, and reduced stress during, say, a downturn or a market contraction. Scenario B is a 15% down payment. Let's say it's a DSCR, a debt service coverage ratio loan, with $45,000 down. You preserve $30,000 in capital, but your higher monthly payment, increased sensitivity to rental shifts in the market, and you have higher long-term interest costs. Most investors stop at monthly cash flow, but that's an incomplete analysis. You're optimizing for three main variables. Remember, liquidity, durability, and deployment velocity. If the preserved $30,000 can then be deployed into another stronger asset or improvements or a second market with some sort of asymmetric upside, then leverage may increase total portfolio return. But here's the constraint. If you cannot maintain at least 6 months of PITI, that's principal, interest, taxes, and insurance, and operating reserves per property after closing, your structure may be too aggressive. And that risk compounds, especially as a portfolio grows. So if you want to talk about a little bit of a more sophisticated way to think about it, leverage versus fragility. Leverage does not create returns. It amplifies structure. If the asset is strong, leverage accelerates compounding. If the asset is marginal, leverage accelerates the stress in that portfolio. And here's the reality many investors ignore. If your deal only works at maximum leverage, it's not a strong deal. In 2025, lenders are increasingly analyzing post-closing liquidity, global debt-to-income ratios, portfolio exposure, and rental income sustainability. Is this rental market going to be a producer for a long period of time, or is it just performing asymmetrically today and maybe for the next year because of a certain key variable? Strong liquidity often gives investors more flexibility than simply chasing lower down payments. Sophisticated operators protect optionality. They don't maximize leverage blindly. So let's talk about risk and risk modeling. Most investors like to skip this conversation about risk. So before choosing 15%, 20%, 25%, 3%, run this stress test. What happens if rents drop by, let's say, 10%? What happens if vacancy lasts for 90 days or 120 days? What happens if insurance increases? What happens if taxes increases? Ask yourself, has insurance ever increased? Has taxes have taxes ever increased? And the answer is going to be overwhelmingly yes. So if the property remains stable under conservative assumptions, leverage and more leverage may be justified. But if a small shock creates strain on the system, if it increases equity input, your down payment is not just a financing decision. It's a volatility control mechanism. So let's talk about strategy and how to decide which down payment is going to be best for you. It's important to evaluate 5 key items. First, liquidity buffer. Do you have 6 to 9 months of total carrying costs per asset in the portfolio? Second, cost of capital versus asset yield. Is your mortgage rate materially below the expected stabilized yield? This is also called your debt service coverage ratio. Number 3, deployment pipeline. Do you have another opportunity, a very strong opportunity, ready where you can allocate cash? Or is this cash that you preserved via a lower down payment just sitting idle on the sidelines doing nothing when it could be working toward reducing risk in your current asset? Number 4, portfolio concentration. Are you increasing exposure to one submarket or are you diversifying intelligently? And then number 5, time horizon. Are you building for income stability or equity acceleration? The percentage you select, it should reflect your portfolio thesis, not a lender's baseline requirement. If you're allocating meaningful capital into Texas real estate this year, this is not a decision to make casually. Down payment structures affect return profile, your risk exposure, liquidity posture, portfolio scalability. If you'd like a structured review of your financing strategy and a capital allocation plan, we should schedule a consultation together. Myself, our team, will analyze leverage decisions through a long-term portfolio lens, not just loan approval criteria. And if you value disciplined, strategic real estate analysis, please subscribe to the channel. Follow us along. We publish a deal distribution list every Sunday, Tuesday, and Thursday because in this environment, intelligent structure, that's our edge.